All right. We open it up. Sure. Okay. Welcome. I hope you guys are having a good Friday and things are going up your alley. So welcome back to another session, an enjoyable session. This time we're going to talk about accounting and financial information. We're going to talk about the fundamentals of how money is managed within a company. So eventually what we're gonna hopefully be talking about is looking at explaining the difference between managerial accounting and financial accounting, identify some of the users of accounting information, explain how we use it, explain the functions of the income statement, understand how income statement is going to be done, why do we need income statement as well, and eventually the functions of the income statement, okay? So we're going to explain the functions of the balance sheet. We're going to understand how to calculate both assets, liabilities, shareholders' equity, company equity, and eventually talk about the functions of a cash flow statement, evaluate the organization's performance, using financial statement to see exactly how healthy they are based on ratio analysis. And we'll talk about those ratio analysis today and hopefully explain a lot more about how the intricacy of accounting and financing is working. So eventually, whenever we are going to kind of talk a little bit about the idea of understanding the fundamentals of accounting, one of the things that we actually understand is the role it plays in the company. So the role that accounting does play is often called the language of business. And the language of business, because it communicates so much of the information that owners, managers, investors, and everybody who's supposed to be a stakeholder, they have to evaluate the company's financial performance. Okay, so these people are stakeholders in the business. They're interested in the activities, and because they're affected by them, and the longevity of the company, they start to understand a little bit more about what this all means and how we all have to put it together. So nonetheless, of course, when you look at the fields of accounting, there's two types of accounting that we look for. We look at management accounting, okay, where we manage the day-to-day basis, the general ledger, the balance sheet, accounts payables, accounts receivables, the bookkeeping, and eventually financial accounting. That now we're going to be looking at finance. We're going to be looking at the success of the company, and eventually we're also going to look at how we manage it properly. So when you look at management accounting, it's also known as managerial accounting. It plays a vital role. It plays a very key role in helping managers carry out their day-to-day tasks and the responsibilities in making sure that their company breaks even. And eventually, financial accounting is also a big part because it's very important, and it's responsible for preparing the organization financial statement, including the income statement. We call it profit and loss statements, P&L statements, and the statement of owner's equity, the balance sheet, and the statement of cash flow. It's very important on financial terms, and that's why accounting and finance are interrelated. So a lot of times when we summarize a company's past performance and evaluate its current financial conditions, one of the things that we are going to be looking at is try to understand a little bit more from the financial side. So when we look at summarizing the outcome of a company's financial activities over a specified period of time, financial statements are in fact a good source of a report card. Okay, they tell us exactly how what we're doing. The same way that we're probably doing it in the same exact motion on reporting cards for owners and managers. And they show, for example, whether the company is taking a lead in what they're doing, whether the company did or didn't make a profit, and furnish other information about the company's financial health. So we're talking about the financial condition. So they also provide some information that managers and owners can use in order to take some form of corrective action. And those corrective action through the reports are produced by management accounts and the accounting department to offer a much greater level of detail and depth on how successful the company is. So who uses financial accounting information? Okay, a lot of times it's the owners and managers. They look at their system. They want to make sure that their system is healthy and good. But also it's open for public, domain. So a lot of investors, a lot of creditors, they also look at it. Government agencies, they look at it as well, and then other individuals as well. So investors and creditors furnish the money that a company needs to operate. And not surprisingly enough, they want to know exactly how a business is performing. And businesses are required to furnish financial information and to look at a number of government agencies to make sure that these government agencies are in place altogether. So there's a number of other outside factors that are used to have interest in the company's financial statement. And the idea behind this is that when you start to look at the functional financial statement, the idea here is to understand what the income statement is all about. So when we look at income statement, it shows us basically how much sales are coming into the company, how much expenses were being taken off, and whether or not the profit was made, meaning that after expenses, after losses, and so forth, did we still make any profit from that single sale? We did make a profit. We have to start to analyze why. However, there's also a balance sheet. And inside the balance sheet, it tells us a little bit more about our assets, meaning that we have property in hand, we have goods in hand, we have items in hand, and also liabilities of what we owe money. Okay. So our assets are basically our infrastructure. It could be, of course, our area of interest. It could be a lot of things altogether, but the amount invested in the business is based on the balance sheet. So again, when you look at your balance sheet every single month, you know exactly the value of your company. Okay. So for example, regardless of sales right now, if we were to sell a company on May the 1st, we can tell people that as of April the 5th, our company right now is worth roughly $10 million. How do I get to $10 million? Very simple. We have about $12 million in assets. However, we have to minus that from our liabilities because you owe $2 million. So that means that if somebody was to buy it on agreed paper, what that happens to be is that they're going to pay a certain amount of it only at the end after liabilities are covered. Okay. Then, of course, you have statement of cash flows. And in statement of cash flows, it shows how much cash is coming in the company, how much is going out. So that means, of course, when you look at an organization, lots of organizations, they definitely want to make sure that we have a lot of account receivables, meaning that people owe us money, it's got to be received, but it might mean it will take some time for it. Or accounts payables, okay, within the accounts payables itself, a lot of times there is a certain amount within the relativity of it that wants to make sure that based upon the area of the cash flow, we want to make sure that when we're looking at money coming in, coming out, we want to make sure that we're paying on time, like a bill. We're paying, our hydro on time, our lease on time, and we're getting money to pay it off. Okay, because a lot of times you have customers the same way hydro or electricity has customers, and some people don't pay it off. So you want to make sure that accounts are being dealt with on a timely basis. And eventually, the goal for many companies is to make sure that the financial statements are going to be clear. So accounting equation is very simple. If you look at assets, some of the assets may be liabilities, okay? Meaning that to get to how much your company's worth, you look at your liabilities, meaning how much I owe people money. So again, the example I try to tell the class is that you may owe $2 million. So that's minus because it's not good. You're losing money. However, owner's equity says that your company's worth right now on your land, on your assets, on your inventory, on your machines, patents, brand name, you name it. Owner's equity is 12 million. So assets for a company right now means it's 12 million in owner's equity minus, or you add it, but it's a minus $2 million. So our assets right now are about $10 million. Okay. So to get to the assets, you need to take away both of them altogether. Now, another important part is the cash flow statements. Inside the cash flow statements, you're looking at cash on hand, okay? Cash that you get from things like your operation, okay? Money that you make from your day-to-day operations. So if you're going to get money, money will come in. Then you get cash from investing, okay? Money that you put in the stock market, and every so often you get dividends, you get owner's equity, you get to return it, buy them low, sell them high, and eventually make some money from investing your good assets. And then cash from financing, okay, meaning that there is cash from financing items. And eventually, what that tells us is that we'll still get money from another source or another part of our company. So when you get all this information and you have a financial statement on hand, you have to start to analyze it a little bit more to try to figure out exactly where it's going to be and how it's going to be dealt with. Okay. So a lot of times when you look at cash flow statements and financial flow statements, one of the things that you're looking for is a different trend analysis of income statements and different areas altogether. Okay. And by looking at profitability ratios, by looking at the area altogether. Okay. A lot of times when you are going to be understanding this area, we're going to be looking at profitability analysis and ratios, and eventually we're going to be looking at debt to ratio analysis as well. Okay. So based on ratio analysis, what we're going to be looking at is trying to deal with liquidity, understanding of where liquidity falls in, making sure that we can be effective and efficient. And by doing simple analysis, simple Excel spreadsheets, we should know exactly where money's coming in, where money's coming out, and how to properly be able to evaluate it. Okay. Okay, and a lot of times when we start to look at financial statements, the idea of financial analysis is to try to understand a little bit more about the patterns that we're making, if the company is profitable, if the company is doable, if there's any success in a company, where does the company fit in, and eventually, what does a company need to do in order to get there? Okay. So what I want to do, I just want to show you a very quick example of, just a basic accounting followed by financials. I did have the video up in the beginning, but then I fumbled it. Okay. So I just want to show you financial accounting. Um, and I just want to show you what this means. Okay. And to show you it very nicely, where was that video? All right, I'm gonna just merge it together onto this one. All right, so here you go. Okay, enjoy the video. And this will give you a brief overview of assets, liabilities, and beyond. Okay, take a look. And oh, one more thing. Give me a thumbs up if you can hear it. Very, very important. And here you go. Can you hear it?
You know what conversation starter will make you the life of the party? Spreadsheets. Maybe not unless it's a wild accounting party or if everyone really loves math. Even then, Honestly, spreadsheets are kind of the vegetables of the
Thank you.
business world. The very idea of them makes some people queasy. But that is okay. Yes, they can be intimidating, but they're not impossible to understand. Today we're going to learn to love them because basic accounting can make or break a business. If we lose track of expenses or overestimate a revenue stream, we might end up questioning where all the money has gone. The key is using organized systems and knowing the right vocabulary. And by the end of this episode, we will be bookkeeping pros, or at least able to talk about balance sheets and profitability with an accountant. I'm Anna Akana, and this is Crash Course Business Entrepreneurship. Every entrepreneur has to seriously think about how we're going to take in money and where we're going to put it. The place, and it could be a digital place, where customers hand over money in exchange for a product or service is called the point of sale. Cash registers, credit card machines, the checkout page on a website, these are all points of sale. Now, we want to make the buying process as painless as possible, so customers will feel good about doing business with us. And having a seamless point of sale system is a big part of that. Here are a few options. Some of the most popular electronic systems are created by Shopify, Square, and PayPal. Both Shopify and Square help you set up e-commerce sites and have hardware to use in physical stores to register sales. And PayPal is an online checkout system that makes it really easy for customers to make purchases. These are great options for entrepreneurs with a lot of transactions or who are selling a product. If your business isn't set up for immediate transactions, you can send customers invoices, basically itemized records, to get paid. Many freelancers do this. Customers may want to pay by credit card, so you might still look into one of those systems that we mentioned. If you're using a system that can process credit cards, there will probably be a 2 to 4% processing fee, so you'll want to take that extra cost into account when pricing your products. Then, of course, we're going to need somewhere to put all the revenue, like a business bank account. This is just like a personal account, except it has a business name on it. Unless your personal account is just under your mattress, in which case it's very different. This move is all about organization. Imagine scrolling through your transaction history if you only had one account for both you and your business. It is just a swamp of latte receipts, supply runs, grocery bills, production costs, cat litter, and more. Some of those were personal lattes, and some were business lattes. And when tax season rolls around in a few months, are you really going to be able to remember the difference? No. Most importantly, we want to be able to tell at a glance the financial health of our business. If calculating profit becomes a guess and check walkthrough of every purchase we've made this year, that simple revenue minus expenses equation is suddenly much more complicated. To get set up in the United States, you'll need your tax identification number, the official name your company is operating as, and most likely proof from your Secretary of State as to what kind of business entity you're running. Depending on whether you've decided to be an LLC, a corporation, a co-op, or something else, you may need additional forms. Start with your current bank and see what they offer for business accounts, but do not be afraid to shop around. Can you find free checking, free savings, better loyalty rewards? After getting money from customers and storing it safely, we want to keep track of how much we have and how much we've spent. And some idea of how well we're doing would also be nice. We can track almost anything and make tons of beautiful graphs, but there are 3 essential reports to measure our business's financial success. These 3 reports are also well understood by other business people who might be trying to help us out in the future. An income statement, sometimes called a profit and loss statement or P&L, is a report that shows how much money we've spent and how much we've made during some period of time, usually a month or a year. Basically, it tracks the total revenue, total cost of goods sold, the total expenses, and comes up with our net income at the bottom, which is total revenue minus cost of goods sold, minus selling, general, and administrative expenses, minus all our other expenses like depreciation of equipment or taxes. It is important to write down every revenue stream and every expense, so we are getting a complete picture of what our net income is. The second report is a balance sheet. This is a snapshot of our business's financial health at any point in time. So on the income statement, we looked at just December or just 2019. But here, we're looking at all of our money for all time. And there are 3 sections. The balance sheet will show our assets, not just our cash, but anything we could convert into cash within 1 year, like property, equipment, investments, or intellectual property. Assets are broken up into 2 categories. Current assets are anything we could convert into cash within 1 year, like cash or inventory. And fixed assets are purchased for long-term use, so we probably can't convert them quickly into cash, like land or buildings. It also shows our liabilities, all our financial obligations and debts, like loans, mortgages, revenue we're waiting on, and expenses. Like with assets, liabilities are broken up into 2 categories. Current liabilities are debts that must be satisfied within 1 year from the balance sheet date. And long-term liabilities are debts that aren't due within 1 year of the date of the balance sheet, like mortgages. And it shows our equity, or the amount of money that would be returned to our shareholders if all of our assets were turned into cash and all of our debt was paid off. Many of us may not have shareholders yet, but we may have a friend or family member lying around that we just got to pay back. These three things balance, hence the name balance sheet. Equity is really just assets minus liabilities, which we rearrange to make the business equation assets equals equity plus liabilities. Finally, the third statement we should be familiar with is a cash flow statement, which tells us how much money has moved in and out of our business in a specific time period. Again, like a month or a year. There are 3 sections to this statement too. The operations cash flow shows how much cash was spent or earned from running the business. So this includes revenue, expenses, and taxes. The investment cash flow shows how much our business sold or spent on property, plant, and equipment, or PP&E. This is stuff like selling old equipment or purchasing a new building. And the financial cash flow shows the amount of money our business got in loans or paid in dividends to shareholders. Now, we can remember these 3 sections with a made-up word, OIF. And all 3 are added up to show the net cash flow for our business. Since we're looking at a specific snapshot in time, we can add in whatever cash we had from before to see the total amount of cash our business is sitting on. Let's look at an example in the thought bubble. Ronnie has his own event planning business, and this year he's planning some weddings, quinceañeras, bat mitzvahs, and fancy pool parties. But is his business doing well? On his income statement for January through April, we see he paid for SG&A costs like his website and his monthly accounting software subscription, but he had revenue from planning 3 events. His net income is positive, meaning he made a profit for these months. Nice. On his balance sheet, we can see that he received a bank loan, which is a liability. This loan is considered a current liability if it will be paid off within a year of the balance sheet date. Otherwise, it would be a long-term liability. He spent almost all of this cash from the loan on event decor and a tech setup, a computer and tablet and one of those headset things all the official event planners seem to have. All of this stuff, plus any cash he has from his net income, are his assets. Now, to calculate Ronnie's equity, we subtract the total liabilities from the total assets, and there's how much he actually owns. Boom! Balance. Finally, on his cash flow statement, we see 3 categories. The operations cash flow includes revenue from his customers and any cash left over from the loan, so his operations cash flow is positive. The investment cash flow includes the money he spent purchasing new decorations and upgrading his tech setup. Since he didn't earn any money here, his investment cash flow is negative. And the financial cash flow has the bank loan that funded all of his upgrades. His financial cash flow is positive because that money came into his business. So overall, Ronnie's making money, though he does still need to pay off that bank loan. Hopefully that new decor and tech will get him even more business. Thanks, Thought Bubble. To create these statements, we can make our own spreadsheet for free, but that might require a lot of data entry. Yay, spreadsheet fun. I actually really like spreadsheets, so it is fun. Accounting software can be really efficient, and depending on our price range, many accounting software systems have options for generating invoices and can play nice with our point of sale system. Since many people are intimidated by anything accounting related, not me of course, there are tons of great choices. HubSpot has collected a list with a quick analysis and cost breakdown, and we can put a link in the description for you. Some of the most common choices are QuickBooks, FreshBooks, and Xero. QuickBooks is by Intuit, the same company that creates TurboTax, and is probably the most well-known software for businesses. It can invoice people and interacts with many point-of-sale systems. FreshBooks is also popular and offers very similar options to QuickBooks, but it's usually recommended for subscription-based businesses. And Xero is what Square recommends. So if you're using Square as your point-of-sale system, you might try Xero because they work really well together and pricing can be a bit friendlier. Do your research to make sure whatever you pick works well with the systems you already have, but ultimately, you'll get very similar results with any of these. As we make more money, we might want to bring on a key partner like a bookkeeper to handle the data, or an accountant to manage projects and taxes. There are even services like Bench or SLC Bookkeeping that will act as virtual accountants, but a local firm will also be glad to help you. If this is the path you want to take, you should still review your income statements, balance sheets, and cash flow statements regularly and know what they say. This is all the behind the scenes action of your business, and you don't want to miss out or get taken advantage of. Remember, you are in charge, so consult everyone you need to understand reports and strategize, but make sure that you are still the one making the final call. So we have these 3 reports as printouts or PDFs, but how exactly do we read them?
Go ahead.
Yeah. Oh, this is my gross margin is half my dividend payout ratio. That can't be right. There are hundreds of different metrics we can use to see how efficient and profitable our company is, called accounting ratios. Because there are so many of these, we suggest pulling up our old friend Investopedia to research on what could matter to your business. This is where finding a key partner who knows their stuff can really help. And finally, we'll say it again. Do not forget to file your taxes. You'll probably have to submit 1 or more of your financial reports along with the tax forms, but good thing you're prepared. Depending on the country and type of business, there will probably be different requirements. In the US, you can find most of what you need online. For federal taxes, visit irs.gov. For state taxes, look on your Secretary of State's website or visit your state Department of Revenue. And for city or municipal taxes, drop a hay penny in the town fountain and whistle, "She'll be coming around the mountain when she comes." No, seriously, you should also check your city's website. The bottom line is on your income statement. No, but really, bookkeeping can be fun, or at the very least, understandable. Set up systems to manage your revenue and invest in software or people to keep your business organized and profitable. Next time, we'll keep talking about money and look at the funding options for when you're just starting out. Thank you so much for watching Crash Course Business, which is sponsored by Google. And thank you to Thought Cafe for the beautiful graphics. If you want to help keep Crash Course free for everybody forever, you can join our community on Patreon. And if you want to learn more about taxes, check out this Crash Course Economics video.
All right, thank you. Okay, I hope that that gave you a good crash course on some fundamentals of accounting. Nonetheless, for now, I'm gonna take a break. Okay. When we are back, what we'll do is we'll go into detail with personal finance, and personal finance is going to be a little bit more about now that you make money, now that your company is profitable, how do you take that money and eventually use it for your own good? Okay, stick around for that, and we shall be back in 10 minutes. Okay, so let me just go back to the break. The time, whoops, do apologize for that. The time right now is it's 5 o'clock. So please take a 10-minute break, come back at 5:10, and we will restart. Okay. Enjoy your break, guys. I hope accounting was sufficient for you. And I will see you guys here in a jiffy. Bye for now. I'm just gonna pause it. The other side, when you start to look at personal finances, you can make a little bit more money and then some. Okay. And a lot of people, they do not know how to balance their life. Okay. So why are you buying 2 cars? Why are you buying 20 shoes? I know, and I know who I'm talking to here. Why are you buying, things you cannot afford? Okay. So in personal finances, you want to think about today, tomorrow, and the future, and look a little bit more about how to manage your money. And that's part of life, but that's also part of business as well. So what we're going to be looking at is defining the personal financing and financial planning that many companies, many individuals partake. Talking to you guys about financial planning cycles, explaining why compound interest and time value of money is very precious. And that's why I encourage you guys to invest today and definitely grow for tomorrow. We'll talk about the advantages of how students like yourself, college students, are using financial leverages and meeting short-term and long-term goals. Because again, when you are a student, you have time, but you can make money. You can go to school, you can invest, and eventually you want to make the most out of it. So we're going to discuss the value of getting an early start on your plans for savings, explain how to manage monthly income and expenses, and hopefully describe strategies to minimize and manage debt in a healthy, constructive, and formidable way. So now let's, of course, one of the things that we hopefully want to talk about is what are personal finances. And in personal finances, it's basically finance that concerns the flow of money from one place to another. Okay, the flow of how money is being given to you, the flow of how money is being sent to you, and eventually how you manage it on a personal level. So personal finances is the applicable financial principles, and we look at ways of having a decision to make your money either for your individual benefit, for your family, or for something else. But either way, it's your choice what you want to do with the money. Okay. So because we have the choice in our lives, the question now is, how are you going to spend the money and how are you going to budget it? And a lot of you guys are budgeting it right now. You guys are students. You work part time, you make money, you go to school, you want to make sure everything can be balanced out. So when you look at the financial planning and how financial planning is going to be done on the ongoing process of managing your personal finances and making sure that in order to meet goals and make sure that your goals you have set yourself and your family apart, the idea that you want to create here is being able to align yourself within the same kind of margin to make sure that after everything is paid out, you're gonna have a little bit more extra money. Okay, so the question is, you can save it, you can put it in a bank, save it, and it'll grow. Some banks give you interest. You can take it and eventually, give it in the stock market. You can do a lot of things in it. Okay, so again, just gonna when I wrote this, it was written in before I put the paper inside. So the idea of understanding some ideas behind the financial leverage is to ask ourselves, okay, well, we're trying to make some money, and when we create financial plans, it's an ongoing process of measuring your personal finance to make sure that the money will grow. And money does grow. Money grows in real estate, money grows in stocks, money grows in mutual funds, money grows everywhere. But the question is, how are you going to invest it and how much will you invest it? Clearly, you cannot invest all your earnings every single month. You have to give some away to taxes. You have to give some away to other different departments. It has to be done holistically. So in order to meet the goals you have set for yourself and for your family, the idea you want to create here is to create a financial plan. So financial planning is all about the leverage that you will have, especially on making sure that when everything is said and done, you want to make sure that within the financial plan, you want to ask simple questions about where your money is going. Okay. For example, your financial plan can be prompted by a series of questions that you ask yourself to consider the state of your health within your personal financing over time. This includes your working years for your retirement and eventually your annual income statement. How much money do you make? Okay. That will determine how much you can afford, how much you can lease, how much you can finance and beyond, how much debt you have. So again, like we mentioned with a company is very similar to a human being. When we look at a company, we have our assets, and your education is your asset, your degree is your asset, your experience is your asset, your money you save is your asset, but you also have debt. You may owe company money. You may own personal money, meaning you paid to go to school, and that money simply means that it's an option for you. And what is the value of your assets? What kind of assets are you looking for? How much wealth can you expect to accumulate during your working lifetime? So again, when we're talking about lifetime, some of you guys are in your 20s and 30s. You have to decide how your life is going to look like 40 years from now. Okay. What are you going to do in your 70s? Okay. How are you going to be when you retire? So when you put money down today, 40 years down the road, it will grow and will accumulate all of a sudden. So when you look at how much money will you need to retire, a lot of the cases is that, you know, you don't really know how long you're going to live. So, when you're retiring at 65, the goal is the next 30 years. So, can you imagine 40 years of working and then another 30 years of retirement where you basically live off of the money that you made and your Canadian pension plan. Okay. So a lot of times when you start to look at that, it's basically how you're going to live. And, a lot of times, some people, the goal is to accumulate, let's say, $1 million. So you get your down payment, you get $1 million, and you slowly use it for the next 30 years. Okay. Use that money and eventually you want to retire properly. So the question is that whole financial freedom goal of asking yourself, what happens when I do retire? So the question is that when you look at the average person's lifespan, there are three stages of the financial planning life cycle that they overtake. And again, I'm just gonna make it nicer for you guys because a little bit hard to see. When you look at the financial plan, the goal is that number one, you're building wealth today. Okay. So as you make money, you put a little bit of money in, you pay taxes. And when you look at your statement in your job, you're paying into your EI, employment insurance, you're paying into your Canadian pension plan, and then other miscellaneous items. Some companies will offer you things like your RRSP and contribution to RRSP, so retirement saving plans that are available. And that means that not only do you make it, but also other individuals that will be making as well. But some companies will be competitive. And what they'll do is that they will match it. So if you put $300 per month on your RSP, they will match it to 600. Okay. So that means you get 300 from yourself, 300 from the company, and eventually you're building wealth from that point on. Then, of course, you have a way to preserve and increase the wealth, meaning that you can increase it a little bit more. You can be able to reinvest on it, do a lot of things on it. And when you preserve and increase wealth, there will be bumps. You need to buy a new car. You need to do new renovation. You need to go into an emergency. You may need to buy a mortgage. There's a lot of things that go into it. But when you preserve and increase wealth, the idea behind this is that you want to make sure that it could be done properly. And eventually, in the third stage, you have that things are when you live on a saved wealth after retirement. The idea here is that when you live on, and if possible, continue to grow on one's safe wealth retirement, that's all you have. Okay. So you're actually not making any money after a certain period, whether you're 65 years old or 70 years old, but you built wealth between your 20s, 30s, 40s, and 50s and 60s, and then you preserve it, you grow around the wealth, and eventually, let's say you have $1 million, and I'm just doing like simple math here, on top of whatever the CPP is on that point, if you're taking say $1 million that you invested and you are putting that money for let's say the goal is 30 years of your life, that means every single year on top of your CPP, which is like, I'm not gonna lie, it's probably like somewhere in the range of like $30,000. So for those who didn't save, they're going to get $30,000 to live off of. For the others, they might start only at maybe 33,000. So can you imagine, okay, that some people they're getting something in a range of $63,000 a year, and they can do it in small payments, and that goes towards vacation, that goes towards life enjoyment and anything that comes in that stage of your life. So when you look at everyone's financial planning life cycle from building wealth, preserving and increasing wealth that one has accumulated and continues to accumulate, and when they retire and continue to grow, how much they have to live off of, everyone's financial planning life cycle will change. And wherever there's going to be differences, it can be complicated in each state because the complication means that you may have a change in marital status, meaning you get divorced, separated, a loved one passes on. You, throughout the next 40 years, you also have changes in your employment status. You might be let go, you might be promoted, you might be fired, there might be a downturn. economic recession or a continuation of boom. You never know, but it's not always going to be the same. And there's also changes in the needs of family or dependents. Okay, all of a sudden, you know, your kids right now are in middle school. By the time that they're in their 20s, they're also going to go to Centennial College. And when they go to Centennial College, they need tuition, they need dorm, they need food, they need everything. So you may be dependent to them for the next 4 years until they graduate, and then sometimes afterwards. So please remember, guys, that when we start to look at the different stages of the cycle, when you are a young adult right now, you're simply creating some priorities. So a lot of times when we're in our 20s, the goal is to consume and save. But on top of consuming money, putting money into our life, we're young, we want to travel, we want to buy clothes, we want to buy food, we want to see our friends, we go into debt. Okay, so as we formulate the friendship and the family, we go into debt because eventually we have to pay mortgage. And even the word mortgage comes from a French word called debt, like a mort. Okay, mort means you are like not immortal but mortal, and debt and gauge means dead. So debt it means. Okay. So when you look at, talking insurance and planning, the goal is, what happens when you pass on, what happens when you go kaput kaput, all these things matter. And then when you go into family maturity, when you go into investments and estate and planning, the stage just changes. Okay. So, in life events, you will retire in the first stage. Okay. In the first stage, this means, of course, that you are going to retire, and eventually, when you do retire, you want to be able to live comfortably. Okay, but the thing is that you invest money now, and when you do retire, CPP will grow, your money will grow, and eventually, maybe $63,000 is going to be a new $20,000 40 years from now. Okay. So what that means is that you're going to be prepared for it. And the reason you're prepared for it is that you're not just putting money in, but money has a value. And the value of money is that there's something called compounding interest. And within compounding interest, the idea behind compound interest is that it's affected by earning interest on your interest over time. So the effect of earning interest on your interest over time means that on top of the money that you're making, so let's say you invested $100 this year, you're gonna get $10 in interest, okay, 1%, let's say. And eventually what's gonna happen is that 110 now gets compounded again. So you're gonna get 100 plus another 100 plus whatever it's gonna come in, and it will be a rolling ball, like a snowball, just getting bigger, bigger, and bigger. That's why this is very important to talk about personal financing, because the effect of earning interest over time, 40 years, means that every single year you're getting like 10%. On top of that, you're getting a 10% of that 10% that you earned. Okay. So basically, what's going to happen is your principal is like 30,000. Okay. Over like 40 years, but you also made 30,000 on interest, and that 30,000 also is compounded to make, let's say, 30,000. So altogether, you made like 630,000 just by of the principal, the interest, and the interest of the compounding interest. That's banking for you, okay? But the idea here is that when you really, really think about it, it's just money that earns money that earns money if you just store it in the bank, okay? So compound interest is the effect of earning interest on your interest over time. But eventually, when you look at compounding interest, the idea here is that you can actually look at an investment calculator, and the investment calculator can give you a better idea of what kind of investment there will be in the future. So there are many calculators to use, like the one that I kind of showed you here from the Bank of Canada, and it will allow you to see your growth of your current investment over time at different levels of interest, and eventually how much money you will accumulate. So again, if you want to look at it, I've left it down here, and I'm gonna present it to you guys. So what's going to happen is that whenever you're going to be looking at the compounded interest, the idea of the whole compounded interest theory, and I'll just give it to you guys nicely here. Where's my second? Oh boy. Okay, right here. Okay, here we go. All right. So what I'm going to show you, if you go into our Zoom chat, and I'm going to put it for everyone. If you want to click a like and acknowledge that you got it, just put a like here. And yeah, thank you. All right. So basically what you can do, and I'll just show you very quickly, and you can follow with me on if you want to play around with financing. So what I've done, all right, and thank you for, who's that? Chan and Shibuzu. What I've done is that the invested calculator shows you the effect of inflation and investment of saving. Now, we don't know what the percentage might be in the future. We can only guesstimate, but the results show that the intended references do not necessarily reflect what will be obtained in the actual investment situation. So assume you have an initial investment of $100,000 and you started in 2019. The question is, how would it look like in 2039? So based on an annual average interest of 2.2, inflation rate of 2%, you can actually calculate it. And when you do calculate it, it gives you an output of how much that money went forward in the next 20 years, okay? To make sure that that money is going to be valued, appreciated, and eventually that money is going to be put aside for good uses, okay? So when you look at time and value, and I just want to give you that example very clearly of how time and value goes in, based upon the investment calculator that you can kind of play around with. And let me just see who kind of took advantage of that. All right, a couple of people, awesome. All right, so when you look at yourself right now, okay, the time of value is a principle whereby a dollar received in its present is going to be worth a lot more than received in the future. So what that tells you is that there's $1 million question that if you win the lottery today, what will be the outcome if, for example, you were to, in a possible way, you were to take that money, and eventually, when you take that money, you're going to be asked, do you want it in installments, money for life, or do you want the lump sum? So to give you a better idea, as a personal advisor for you, I would tell you to take the money up front, okay? Because right now, that money has more value now than just getting, let's say, $400,000 every year. Okay, you made like $20 million in the lottery. I'd say take the $20 million, and eventually, after years of investment, because you're not going to use all that money, I hope you're not going to use it for malicious things, I hope, but that money will eventually double itself. So eventually, by the time that you reach like 40 or 50, you're still back to $20 million. That's the whole idea of finance. So the idea times value of money is that value in the future means a lot more. So for example, when you look at real estate once cost $100,000, and today houses are about 800,000. So they went 8 times the value, 8 times the price. So as you can see, I gave you a simple graph that I got from the Bank of Canada that shows you the difference in financial growth between two individuals, assuming one invested at age 24 and the other at age 35. So the 24-year-old invested $2,000 per year. Okay, that means $2,000 per year is roughly close to about $200 a month. Okay, or roughly $166 per month. Okay, and they did that for 12 years. They stopped adding money in, but uh, based on the compounding interest, they still added money, but their total still grew, even though they're not adding money on it. So by the age of 67, that person had almost $1 million only by investing $2,000 at 24, okay, every single year, and do it for 12 years. So the compounding interest effect comes in. Meanwhile, let's talk about the 35-year-old. The 35-year-old did not invest until they became in their 30s, even though they talked to their friend and said, listen, invest $2,000 every year. By the time you're 67, it will grow. They did that, but they still not caught up with their wiser friend. And eventually that person, even though they did the same kind of process, they only made $500,000. Okay. So can you imagine 12 years early on, compounded, you're going to just compound it over and over again and eventually get the most of it. So what this graph shows you, what this graph tells you here in a financial analysis is in the blue line, one person only invested $12 at 12 for 12 years, $2,000, and became a millionaire at 67. In the yellow line, the other person was able to do 2,000 per year, but that doesn't start until she was 35. So that leaves her halfway in. Okay, so 35 is still young, but in 35, you still did not have a lot to do with it. So this graph illustrates the benefits of saving early and benefiting from compounding interest. But eventually, what many people do based on statistics, a lot of times your personal financing is based on how much money you make. And we talked about that. So you will make some money in the future from your career. And Statistics Canada has shown a higher level of education that correlates directly to higher level of income. So that means you attend Centennial, you get paid. So a lot of times you may also understand that this leads a lot of times to sometimes inequality in Canada. But in Statistic Canada on this table, it shows you the medium annual earning of both men and women aged 25 to 64 who work full time and have a full year as a paid employee. By the highest level of education and province and territory in Statistic Canada, 2015 Census Bureau. Okay, so what that means that if somebody has um, the average income for women, if they're only having a high school diploma, their average income is roughly about 43,000. For men, uh, mainly because, of course, many go into the trade, into construction and so forth, it becomes a little higher at 55,000. However, college diplomas, they're a little bit higher. Okay, they are a little bit at close to $50,000 for women, and roughly close to 70,000 for men. Now, bachelor degree plays a little bit more because bachelor is an undergrad, and people have management levels. So, on average for women, it's roughly about 68,000, and the average for men is roughly around 82,000. Okay, so those are very complicit in what you will do. Now, to understand a little bit better on the area of your credit score, it's not just a simple gain to tell me that, hey, listen, I made good money throughout my career, things are looking sharp, I'm really happy, and so forth. It's really more than that, okay? And what you need to kind of understand here is your credit score is very, very important here. Okay. A lot of times, if you make money, but you simply do not pay, both as a company and as an individual, you're going to be blacklisted. Okay. So if you have poor payment history, if you use, the use of available credit, if you maximize it, your length of credit history, meaning that you paid consistently, the number of inquiries that you opened up about it, meaning the more you open up, the more it's suspicious for the company, and the types of credit that you're looking for, where it's a home credit, business credit, a student line of credit, whatever it is, your credit score is very important. So the goal is that if you pay on time, if you have the money, if you show good credit worthiness, you're going to be rewarded. And a lot of times when you get rewarded in our society, you get a good score, and a good score will allow you to get lower interest, priority in banking systems, a bigger loan, and a lot more. Okay, so can you imagine? You're currently in your 20s, you're not paying your bills. This will haunt you down the line in your 30s when you're starting to ask for a loan. You have the money, and now you're finally paying on time. But what happens here if you're late? Okay, that means that when you try to take out a mortgage for like $600,000, they may tell you based on your previous history, it came back and haunted you. And because it haunted you, what that means is that now you're going to only get $400,000. So even though you have a good down payment, your goal was $600,000 mortgage, and you were denied that. All because you did not pay your bills on time. So please be careful on that. Also, please remember, you can also track your monthly expenses like we do in accounting and financing. You can track your monthly expenses against your monthly income by following a few simple tricks and tips I have for you. Number one, keep a written record of everything you spend and a total it week by week so that you can get a budget. Keep all your ATM receipts and count it up for fees. So you know exactly how much you're paying. So you don't want to take out money almost every single day. Cents here, dollars there, it adds up. Take $100 out of the bank and don't spend a penny more. So that means $100 should be spent for your entertainment. Okay. So that means every single month, $100. Okay. If you want food on campus, that $100 goes in. If you want to go out for drinks or a night out to town, $100. Okay. And don't max it. Okay. So that means that you want to have limits. A lot of times, many people use their card. They go out, and eventually, with tips, with extra drinks, extra meals, paying for your friends, it adds up, okay? And then you realize, your budget was, $1,600. Now it ballooned to like $2,300, all because you did not put a lot of effort in, okay? So please remember, keep everything in paper, manage it, spend some time on Saturday or Sunday to manage your financing, keep all your ATM receipts and count them up, take limits and use that as need be, and hopefully create personal budgets as it should be. So when building a personal budget here, the idea that you want to start to create, the idea that you want to build around is to make sure that when building personal budget is one of the best ways to manage and minimize human beings' debt, and start by number one, looking at income, employment that you're in right now, student loans, expense of food, entertainment, health, wellness, and rent and utilities. And make sure that when you ask the tough questions, what can be eliminated by from my expenses? What can I do to lower it? What can be reduced from my expenses? In what areas can I be smarter in spending my money? Where does my money seem to be gobbled up in? All these major questions are very, very important for your personal financing. Okay. You're smart, you're a student, you know exactly how money comes in, money comes out, because that's what you're majoring in. But you have to make sure that expenses do not go too high. You want to make sure you can reduce expenses. Okay. So save money where needed. And that's where we talked about ATMs. ATMs take, $2 for every transaction. So you want to make sure you're not doing it, week by week, day by day, and eventually losing like $30, $40 per month. Okay. You want to be very, very strong with your money. And in what areas can you be smarter in as a consumer? Where does your money seem to be losing here? Make sure you can investigate it, because sometimes people get their bill, they do not read it very well, and there's all these fees that come in. Sometimes even credit cards, they charge you insurance, and you can never use it. Okay, it doesn't mean that you're insured against what you paid for. It's insured on what happens if you cannot pay it. Okay, so you still have to pay it, and interest accumulates. But the thing is you're insured if you lose a job or something worse. Okay, so a lot of times when this occurs, you want to make sure that some of these major areas are going to be taken care of. So to help you on your journey as in personal financing, what I have for you guys in store right now is another interesting video that I'd like to present to the class on personal financial matters. And I want to introduce that to the students, and eventually have you guys review it and look over it and look at the steps to manage your money in a very basic way. Okay? Basic Finance 101. Enjoy. Personal Finance 101. Enjoy.
Most of us watching this video earn money in some way, but do you have any idea about personal finance? If not, do you know where to start? Are you aware of where you spend or overspend in your monthly expenses? Where are you heading financially? To be honest, the answers to all of these questions are difficult for many to answer, which is why it's really important to address them. Hey guys, and welcome back to the channel. If you're watching, then there's a high probability that you're interested in money. So let's start from the beginning and talk about the basics of personal finance. After all, what good is it to talk about the intricacies of money if we don't discuss where and how to start? What is personal finance? Before we can continue, it's necessary to discuss what personal finance actually means. Personal finance is the management of one's finances through planning, spending, saving, and investing. It's the management of all areas of your and your family's finances, both short-term and long-term. The phrase also refers to an entire business committed to services and products meant to assist you in managing your finances and taking advantage of investment possibilities. Personal finance is an essential component of not just managing your day-to-day financial demands, but also planning for your financial future. The sooner you master personal finance, the better your long-term financial chances will be for things like investing and retirement planning. You can better identify possibilities to improve your finances if you grasp the elements of personal finance. This understanding can assist you in budgeting for immediate necessities while also planning for long-term financial goals. The sooner you begin financial planning, the better. Even if you think that boat has sailed, remember, it's never too late to set financial objectives to provide financial security and freedom for yourself and your family. Here are the top personal finance habits and tips. 1. Set specific financial goals. For everyone, financial success holds a different definition. For some, it's having a credit score above 800, retiring before the age of 50, or assisting your children in avoiding student loan debt. Others may define success as owning a car, second property on the beach, or traveling the world. As with anything in life, not just your money, if you want to be successful, you must have a clear strategy. You cannot expect to fumble your way to achieving your financial goals. You must put thought, effort, and intentionality to determine just what you want in your financial life. Remember that your goals should be achievable and realistic, or else you will soon lose motivation because you'd have no way to truly track them. 2. Begin budgeting. Budgeting is one of the fundamentals of personal finance. Some might argue that it is the fundamental to personal finance. To define it in a single sentence, budgeting is keeping track of your income and expenses so you know where your money is going each month. When done correctly, a budget puts you in charge of your finances. It allows you to spend more on things you enjoy and less on things you don't. It allows you the flexibility to shift as life happens and new problems or priorities arise. A quick Google or check on your phone's app store show you any number of budgeting apps designed to help you automate your life and make the process of tracking easier. Apps like Mint, You Need a Budget, and Personal Capital. 3. Establish an emergency fund. Paying yourself first ensures that money is set aside for unforeseen needs such as medical bills, a major car repair, increase in expenses, and more. The optimal safety net is to have an emergency fund of 3 to 6 months worth of living expenditures. Financial experts normally advise saving 20% of your pay to help you achieve this goal. This may not be a quick thing. Some people take several months or years to save up enough for a rainy day fund. But don't get unmotivated. If you look at the big picture, it will be the emergency fund that saves you in trying times. Continue allocating as much as you can, preferably at least 20%, to this goal. 4. Reduce debt. To prevent debt from spiraling out of control, don't spend more than you earn. Of course, that's often easier said than done, and the truth is, most people must borrow from time to time. Also, going into debt can occasionally be advantageous. For example, if it leads to the acquisition of an asset. Taking out a mortgage to buy a property is an example of this. Still, take a hard look at what items you're obligating yourself to paying off. If it is not debt that allows you to build an asset or something that helps you bring in income, be very cautious about obligating yourself to paying it back. This includes things like cars, tech appliances, and any myriad of items that you're tempted to put on your credit card. 5. Investing. Investing is the acquisition of assets that are projected to create a rate of return in the belief that the individual would get more money than they first invested. Investing does involve some risk, so ensure you know and understand what you're investing in completely before you put your hard-earned money into it. Investing is one of the most challenging aspects of personal finance, and one of the areas where many people seek professional help the most. There are significant disparities in risk and reward among various assets, and most people seek assistance with this part of their financial plan. Risk tolerance is different from person to person, and knowing your own will help you determine the best ways for you to invest. 6. Use credit cards with caution. Credit cards can be significant financial traps, but it's almost impossible to survive without one in today's world. Additionally, they are a crucial component to help build your credit score and a terrific tool to track spending, which can be a huge budgeting help. Credit simply needs to be managed correctly, which means paying off your entire bill every month, or at the very least, keeping your credit usage ratio low. That is, keeping your account balances below 30% of your total available credit. Given the incredible rewards incentives available these days, such as cashback and points, it can make sense to use your credit card more often as long as you pay your bills in full. Remember, never use your credit card to their maximum limits, and always pay your payments on time. Paying bills late or missing payments is one of the quickest ways to destroy your credit worthiness. If you're honest with yourself and no credit cards will get you into trouble, then cut it up and use a debit card. This is not about ego. You must do what you must to help get you to your financial goals. 7. Think about your family. When the time approaches, all of us will die one day. We cannot escape it, but doing certain things can ensure that your wishes and finances carry on. It's never easy to think about things like this, but making your wishes known to the necessary individuals in your family will only help in the long run. Create a will and, depending on your needs, set up one or more trusts to protect the assets in your estate and ensure that your desires are carried out after you die. It would be best to consider a car, home, life, disability, and long-term care insurance. Review your policies regularly to ensure that it matches your family's needs during life's big milestones. 8. Take some time off. The pursuit of personal finance will span decades of your life. Budgeting, planning, saving, and investing can often be very tiring exercises. Make sure to treat yourself every now and again so that you don't get demotivated. Ultimately, life is short, so enjoy some of the fruits of your labor, whether it's a vacation, a purchase, or a night out. This provides you with a taste of the financial freedom you are working so hard for. Also, delegate when necessary. Even if you can do your own taxes or manage a portfolio of individual equities, this does not imply you should. Setting up a brokerage account and spending a few $100s on a certified public accountant or a financial planner might be an excellent approach to help your planning. When you have financial literacy, you grasp all of the facts, tools, and principles required to manage your money wisely. Unfortunately, financial literacy is not taught in many school systems. If you want to be successful with your finances, you must seek out this information. Taking the time to learn and grow in the basics of personal finance can only help you on your way toward financial freedom. That's the end of today's video. If you learned something new today, like this video and share it with your friends. Please consider subscribing and hit that bell icon to get notified when new videos drop. We'll see you in the next one.
Thank you. All right. I hope that you enjoyed that one and it was meaningful. Coming back to what we mentioned, some takeaways here. Again, please remember finance accounting plays an important role for the longevity of a company. Personal finance for you. Okay. I cannot dictate. I do not know where you're going to go in the future, but what I do know is that as long as you have a plan, you have a system, you can go very, very far. Okay. So please take that into consideration. Don't regret it. Okay. Don't have hesitation. Say, I wish I did this when I was in my 20s. I wish I didn't do that. Think about the future and think about where you want to be. All right. Any questions? It's clear. All right. So guys, we're heading towards the thank you, Shibuzu. So we're heading towards the end of it all. So what I want you guys to do is that in today's conversation, I left over the chapter, and I'm gonna give you guys the video for next week. I left you guys business venture group assignment. I left you guys the personal budget and activities that you have. Please remember that the business venture group, you formed a group. Please work on it all together. Please follow the steps that we mentioned in class. In week 12, I have a quick review on what is making budget, and I want you guys to look at it in the discussion and fill it out. You can fill it out until April 21st, but afterwards, we cannot do much about it. So please make sure to write it. Please make sure to fill it in, and you're good to go. When is the final DB due, sir? DB, DB what? The deliverable? What is DB? Discussion board. It's shown right here. So on the discussion board, it's right here, April 21st. Okay. But you have to complete it beforehand. Okay. So please make sure that you follow it. Okay. It's not asking me the question, it's doing your research on it. And there's a little bit of a sample of what you need to do. Also, I guess until today, you have the chapter 11 concept quiz to complete. And afterwards, you're all done. So all you have to do for me under the assignments is by April, the 19th to 21st, you have to complete the following items. So the I gave you a mark for business ethics already. Business case analysis, you have until April 14th. This is the individual assignment. And then the business venture group assignment is due on April 17th. Please also remember, there's also the grace period. Can still get it, but could be a loss of marks there. So you want to make sure that you can submit it hopefully on time without any issue whatsoever. Okay. So please remember, okay, that you need to focus on it. Also, please remember that get one person to hopefully bring it in to the final stage. So I'm gonna leave it for you guys. It's gonna be a chunk, but make sure that you complete it. Make sure that it's good to go, and make sure that you're up to pace on discussion and the miscellaneous side. Okay, guys? All right. Okay, thank you. All right. So other than that, if anybody has any questions, let me know. But next week is our final and last lecture. So next week, what we will be discussing primarily is talking a little bit about, let me bring it up. I know we have to do chapter number 9, we have to cover it, but this will be structure organization. It's gonna be a quick one, and then I'll give you guys a bit of a review, and eventually that will be the end of our class. Week 14, I'm gonna give you guys some heads up on finishing the last item, and then you guys are gonna be good to go. Any questions?
Prof, when is our exam?
Week 14.
Oh, next
Not
next.
next week.
Mm,
Next,
okay.
yeah.
I also have a question, Prof, about the business venture for the group.
Okay,
So
so
you
ask.
posted, yeah, so sorry. So for week 10, you have posted the instruction, right? So under step 1, because there's meet your team and get organized, that's 20 marks. So I was like looking on it, and then there's a portion there that you have to like, introduce yourself in the discussion board. And so how do we do that? Because there's no discussion board that's
There
open.
was, we just bypassed it because we made the groups. Were you here when we talked about it? We mentioned that as long as we made the groups, we bypassed it.
Oh, okay. Perfect. Thank you. And how about the developing a work plan, like, doing like MS
That was
Team?
again bypassed.
Okay, perfect. Thank you. Sorry.
Okay. So a lot
Sorry.
of things are bypassed. I want you to look at the core of the items, okay?
Mm-hmm. Yep.
Make sure you get the venture, make sure you create the plan, Make
Mm-hmm.
sure you allocate it. That's the most important part. Because
Yes.
again, if you don't allocate properly, the meeting and the discussion and the formulation might take a hit from your group.
Yeah. Yep.
Okay.
Yep.
So
Thank
even though you
you.
bypassed it, you still have some issues that if there was problems in the group or
Mm-mm.
possibly there was no allocation being done,
Yeah.
that 20 points or whatever it was could take a hit.
Okay. Yes. Thank you, Prof.
All right, no problem. Any other question? Sure. Okay. All right. So we're done. Okay. Have yourself a good one. I will post the results for you guys hopefully very soon. I hope you enjoyed this lecture. One more lecture to go and then we are done. Have yourself a good one. Stay safe, stay out of trouble, and I'll see you guys here next week. Bye for now. You as well. Take care.
Thank you, Prof. Bye.
Take care, Abigail.